Ladies and gentlemen, welcome back to the channel. Today I'm going to be talking to you about a project that I think is mostly flying under the radar. What they're looking to accomplish is extraordinary, and I am literally banking that this project very well could create an additional crypto $1 million in value for me personally. And I'm going to share with you exactly what I'm doing with this project. I'm going to create an entire playlist talking about this project. So what are we talking about? We are talking about the Beanstalk protocol. Now you may be thinking, Crypto Wealth, how in the world are you so optimistic? Well, first of all, let me just say this before we go any further. Ladies and gentlemen, two things. Disclaimer. I'm not a financial advisor. I'm a very biased cryptocurrency YouTuber. I get excited. I get passionate about decentralization, financial freedom, financial independence, and I love talking about cryptocurrency, and I believe this technology is going to transform the world. So if you believe that, smash that like button, hit the subscribe button, click the bell notification icon, but whatever you do, don't consider me a financial advisor. Don't take financial advice from YouTube. That is not smart. Please don't do that. However, what you can do is take this content, use it as a point of reference to start your own research. What I hope to do in this video and in many of my videos is create awareness. I started my channel because I wanted to create awareness about this technology that I truly believe is going to have an extraordinary impact on the world that we live in today. And this particular protocol, mark my words right now, if this protocol single-handedly doesn't transform crypto, then understand some of the aspects of this protocol. So some of the smart algorithms that they've created, some of these will be used later in other projects if this project isn't able to go across the finish line. I genuinely believe it is that unique and that different, if you will. And I'm very excited about what they're working on and some of the development. So this video is really going to be the first video where I'm going to kind of give a high-level recap of Beanstalk Protocol, what they're doing and what they're looking to accomplish. The next video, I'm going to give a full tutorial on the actual website application and kind of talk about how to use it and what is it. And then third video, I'm going to talk about actually buying the Bean token. How do you buy the Bean token? How do you stake the Bean token? How do you earn with the Bean token? Look, there's 3 different ways to earn with the Bean token. And in another video, I'm going to be talking about some of the additional developments that's taken place. You can subscribe to my channel. I'm going to keep you up to date on this project. I'm going to be following it closely. I'm invested in this project, and I plan to continue to build my position in this project because I think what they're doing, it's going to be extraordinary. So what problem is Beanstalk trying to solve? That's the key. When you're looking at a cryptocurrency investment, it's like, what makes them unique? What are they looking to do that is different than everybody else? Or what's their unique position, if you will? In Beanstalk's case, they're looking to solve the problem of stablecoins. So there's a couple of issues with stablecoins that are existing right now, and we still don't know how this is going to be played out. First of all, most of the popular stablecoins, Tether's USDT, $67 billion market cap, USDC, $53 billion market cap, Binance USD, $18 billion market cap. So you're talking about over $100 billion problem that this protocol is attempting to solve. So what's the problem? All 3 of these stablecoins, the 3 biggest stablecoins on CoinMarketCap, are all centralized stablecoins. This means that private companies own them. Private companies are responsible for providing the backing to them. Now, these private companies are also have to answer to local governments. So now we have a situation where governments can come in and say, just like with USDC and the Tornado Cash incident recently, USDC felt threatened, so therefore they literally turned off access to individuals who, not knowing who those individuals were, not even knowing if they actually did anything wrong, but they turned off access to their USDC coins, meaning their coins were essentially worthless. They couldn't transfer them. They couldn't use them. Imagine having tens of thousands of dollars in your wallet, and all of a sudden it becomes worthless because a private company is worried about something that the government said, yet you did nothing wrong. That's the kind of problems that we can run into in an environment that is still in the process of getting regulated, and people are still trying to figure out what those regulations are going to ultimately look like. So I don't know that long term it's good for crypto. I believe that we need a good stablecoin, but I'm not so certain that we want a centralized stablecoin. Even if you look at something like DAI, but DAI has partially collateralized with USDC, like US dollar coin, which is a private centralized cryptocurrency that serves as a stable coin. So even though DAI is decentralized in nature, their backing is a centralized stablecoin. By extension, a lot of people say DAI is basically a centralized product as well, and I would tend to agree with that. Now, let's go a step further. There's another issue that most people don't think about or they're not actually aware of. Now, this may, for some of you, this is going to blow your mind because you've never actually thought about this before. Why in the world does USDT stay at $1? Why does USDC stay at $1? Why does BUSD stay at $1? What gives USDT a dollar's worth of value? The company behind USDT is supposed to have the US dollar collateral, meaning $67 billion in collateral backing every one of these. So theoretically, if you wanted to redeem your $1 in tethers, you could redeem it for $1, $1 US dollar. Theoretically, that's how it would work. So therefore, they can say, hey, it's pegged to $1 because we have all this collateral. In fact, USDT has claimed many times that they have the collateral. They've literally said, don't worry, all the money's there. Literally, that's been the phrase. Don't worry, all the money's there. USDC, same thing. They're supposed to have $53 billion of collateral just sitting in a bank. Imagine that. They're supposed to have this collateral somewhere sitting in a bank. They don't have a full liquid US dollar backing. None of these probably do. None of them have ever provided, to my knowledge, any sort of full-fledged forensic audit to prove that. Tether has basically given some snapshots of bank accounts without showing where the money came from. Tether is also connected to Bitfinex. Supposedly part of Tether's collateral backing is the very loans they've issued to their own company, Bitfinex. If that sounds a little bit shady, I encourage you to go watch this entire video here. It's unbelievable, exposing Tether, Bitcoin's biggest secret. This is by CoffeeZilla. I'll link the video above. I'll put it down in the description as well. That video basically talks about how it's very possible Tether's not even close to being fully backed. But let's just assume it was. Let's just assume that Tether, USDC, and BUSD were all fully backed. Now imagine what a horrible business model you would have. Think about this for a moment. For every stablecoin that you had to mint, your protocol had to mint, you had to come up with $1 to back that stablecoin. Meaning, if someone wants USDT, they didn't pay the company behind USDT $1 to get a USDT. If you go to your exchange right now, or if you go to, ChangeNow.network or any of those exchanges, if you swap a cryptocurrency for USDT, and a bunch of people started swapping their Bitcoin for USDT, all of a sudden, the company behind Tether would have to mint additional USDTs. For every additional USDT they minted, they've got to find an additional $1 of collateral. Specifically, if the government ever came along, which I believe we're going to see regulations where the government's going to require better backing and forensic audits and that sort of thing. I believe sooner or later the market's going to demand that. If that happens, imagine what a horrible business model. Every time you're succeeding, it's costing you money because you got to find more and more collateral just to be able to have that stable coin. If USDC is successful and all of a sudden they go from 53 billion to 73 billion, they've got to come up with $23 billion. And here's the worst part. They have significant negative carrying costs on that. What do I mean by that? Well, right now, USDC has $53 billion supposedly of collateral somewhere. If it's liquid, that's $53 billion of collateral that is not earning interest, or not earning very much interest, earning 0.05% in a bank account. Maybe they can get a 0.5% somewhere. It's $53 billion in collateral, earning little to no interest. That means it's $53 billion that they can't invest in their business. It's $53 billion, which is bigger than most hedge funds, and yet they can't earn a return on it at all because it's just there for collateral. That's a negative carrying cost, meaning there's an opportunity cost to having to have all this money doing nothing but sitting there providing physical collateral for their stablecoin, their digital stablecoin. So we've got two issues. The fact that there are centralized entities running these stablecoins that have to be compliant, they're susceptible to government regulations. Plus, they have a large amount of capital that they have to hold as collateral that carries a lot of negative carrying costs. So what is the solution? The solution is an algorithmic stablecoin. The problem with algorithmic stablecoins is they haven't worked very effectively up to this point. But Beanstalk Protocol is using a very unique model. And I'm going to show you how this works right now. It's a credit-based stablecoin. So there's an algorithm, and this is a little simple diagram. Hopefully this makes sense to you, but there's an algorithm. We'll consider this line right here, the $1 peg. When the Bean token is above peg, the algorithm has to basically bring it back in line. So what it does is it prints additional Bean tokens, but it doesn't automatically dump those tokens on the market or on an exchange. What it does is it rewards the investors that are staked on the platform with their tokens. So let's just say the Bean token's at $1.05. The algorithm can calculate how many tokens it needs. It's going to print those additional tokens and it's going to send them to what they call the silo. This is where the investors are at that are staked. Now, those of you that are familiar with Tomb Forks, this would be similar to something like the boardroom, but this protocol works radically different than Tomb Forks. In fact, I may do a whole video on the difference in Tomb Forks and this protocol. What happens is when there's additional beans, the protocol will increase the supply and it sends the supply to investors. If for some reason the $1 peg goes down and all of a sudden it's down at 95 cents, what happens is the protocol says, okay, we need to burn the circulating supply. There's too many circulating Bean tokens. So we need to pull them out of the market. Of course, if you decrease supply, sooner or later you're going to increase the price. So we need to raise the price back up to $1. What the protocol does, they incentivize investors to burn their tokens temporarily. Think about that. So they have you burn your bean tokens. How do they do that? Well, the protocol, not only when it's above peg, it calculates how much to print. When it's below peg, what the protocol will do is it will calculate how much interest it's willing to pay. And it calls this temperature, interest. And what it's willing to do is it's willing to pay investors to burn their token. And the way you do this is they create a pod line. Let's just say it's going to pay 20% interest or 50% interest. It's going as high as 5,000% interest. And the whole idea is investors say, okay, I'm going to take my bean tokens, 100 bean tokens, and I'm going to buy 100 pods. And let's just say they go right here. And then another investor says, hey, I got 2,000 bean tokens. Then I'm going to buy 2,000 pods. When you buy pods, you go into a pod line, and it's a direct single file line just like this. As price goes back above $1, then the protocol will mint additional beans. And those beans, of course, now they're going to go two places. They're going to go to the investors over here in the silo, and then they're going to also start paying back the protocol debt. So this is debt. This is the pod line. So the algorithm will start paying back his debt. And the way it pays off its debt is it pays it off first in, first out. The first $100 loan first, pays off the next $2,000 loan next, and it just goes right down the list, paying everybody off all the way down. It doesn't matter if an investor put in $50,000 or $50. It's just going to pay each individual back one at a time, paying off the pod line. The further off peg you will go, the higher the interest rate is. And every single pod has an interest rate attached to it, meaning if they put in $100 and the interest rate was 20%, then it's going to pay back 120%. Or if the interest rate was 500%, it's going to pay back they put in 100 bean, but they're going to get back 500 bean from the protocol once the protocol pays it down that pod. Another way to think about pods is it's essentially like a bond with no maturation date. So you have a bond, you're holding it, you're waiting for it to mature. You don't know exactly when it's going to mature. Another aspect of the pods is they can be sold on a secondary market. Let's just say it's 50%. You got 100 bean tokens in here, you're going to get paid back 150. And you're like, you know what? I'd like to sell this. It's going to mature at 150, but I'd like to sell it for 110. You can list this in the marketplace and say, hey, it's going to pay back 150 when it pays back, but I want to sell it today for 110. And someone may be willing to buy that from you. It's a very neat situation. One more thing. The algorithm will, when it's looking to decrease the supply of circulating bean tokens, not only does it say, hey, we want to take on some debt, we're going to pay interest, they also tell you how much debt they're going to take on. They call it soil, but basically the protocol may issue any number of soil. It may issue 100 soil. It may issue 5,000 soil, 500,000 soil. It doesn't matter. And it's basically saying the algorithm has decided through complex calculations that are in the white paper that it's going to need X amount of soil, 50,000 soil, and it's willing to pay 800% interest or whatever. And usually the interest, it creeps up and down. Right now, at the time of this video, the interest is incredibly high. It's like 5,000% interest at this very moment. For every one bean you put into the pod line, when it pays back, you'll get 50 back. The debt load is incredible right now, but it's looking like it's starting to pay back at a decent clip. So if you're willing to wait, the returns you could earn are enormous. And here's the thing. You would think, who in the world in crypto, who's waiting that long? Well, every single time there's soil, like it gets snapped up. I've yet to see soil sit on the market. There was 200,000 soil. That meant that the protocol basically said, hey, we need $200,000. And I'm telling you, a decentralized protocol had creditors lend $200,000. I want to say it was probably 15, 20 minutes. It was no time. It was gone. Just sucked right up. Gone. It was crazy to watch. So it's very interesting how the protocol is working. And this has worked. It went all the way down to 30 cents before, and it recovered just fine. This protocol also recently survived a DAO attack. The DAO, not the economic model, but the DAO was attacked and it was exploited and a lot of funds were removed. And they recapitalized with something called fertilizer. People come in and they lent fertilizer to the protocol. And now part of the mints, a third goes to the silo, a third pays back the fertilizer, and a third pays back the pod line. It's incredible. But fertilizers here, it's only going to be here until it's gone, basically. And then it will go back to paying 50% to pod line, 50% to the silo investors. Now, when I show you the actual website and how this works, you're going to see this is even more interesting than it looks right here with this crazy diagram. Assuming the next video is already uploaded, and before you get to it, let's talk about the good, the bad, and the ugly. I've touched on some of this already. Here's the good. We're going to start with the good, then we'll go to the bad, then we'll go to the ugly. The good is this protocol has proven to work at recovering peg. Like it's worked. They've recovered, like I said, all the way from 30 cents. The way it was set up from the beginning, it just worked. It totally worked to recover peg. The economic contract has never been exploited. So the government side the project was set up to be fully decentralized. The government side that issues DAOs and that sort of thing, what happened was somebody essentially said, hey, we want to create a proposal that this one address gets all the bean mint. And that's essentially what they did. And it happened with a flash loan attack. But the actual algorithm that controls the actual interest rate, the soil dynamic, that pays the silo investors, that pays the podline, that whole process has never been exploited. It's worked. So that's really good. The relaunch, or what they call the replant after the exploit, seems to have went flawlessly. It's been sitting at $1 right now. I mean, it's holding up incredibly strong so far. Another good thing about this protocol is after the exploit, they had the protocol re-audited twice. And they're actually bringing on a major audit. Halliburton, I think it is coming on as on a retainer to consistently audit it over time, to audit all the new contracts. And part of what Halliburton's doing is they're going to start back from scratch and re-audit the entire protocol all over again. So they're taking the security very, very, very serious. The other thing about this protocol overall is it is solving an enormous problem. It is my personal opinion that in order for cryptocurrency to succeed long term, and it's incredibly important. It's not necessary, but I think it's incredibly important that we can use a stable coin. And a decentralized stable coin, that doesn't require collateral like an algorithmic stable coin, is going to be preferred. Something that is permissionless, something that is censor resistant. And from the start, here's the thing about this protocol. There was no pre-mine. There was no developer tokens set aside. There was no private sale. There was no fundraising. This protocol literally started with $100 in value and grew organically from there. Now it's sitting at about $30 million. And if you look at the market cap of the stable coins, the potential growth of this thing can be extraordinary. I mean, to go from 30 million, let's not even say it goes to 50 billion, but let's just say it goes from 30 million to 200 million, 300 million. 600 million. None of these projects yet are working as a decentralized algorithmic stablecoin that is censorship resistant and permissionless. And that is how Beanstalk is working right now out the gate. Now it's brand new. It's going to have to work some things out. But the problem that it's trying to solve, the potential for this project is huge. And some of the development, I don't even want to, let's just say this. Here's all I'm going to say. Imagine having, you know how Uniswap and SushiSwap and all those charge like a fee, PancakeSwap? It's really low. It's like 0.3% fee to make an exchange. Imagine having a fee-free exchange where literally there's no fees. I know, how is that even possible? You know, how are people going to provide LPs? What's the incentive to do all of that? I know. I'm going to cover that in another video, so make sure you subscribe down below so you don't miss it. But let's talk about the bad. Let's talk about, we talked about the good, and let's talk about the bad. So the bad is this. There's three main risks the way that I see it. First one is, can this project maintain close to peg long term? Bean token cannot be going down to 30 cents and 20 cents and 50 cents. It's got to be able to stay pretty close to $1 long term. Now, as an investor, I'm okay in the short term if we have another depegging event. I'm not going to say that I would shun that too much because I have faith that the project's going to potentially repeg. So as an investor, I'm okay with it in the short term. But long term, if we're going to attract big money to this project, it's got to stay pretty close to peg long term. If it can do that, everything else is going to be really, really interesting. The other big risk is it's got to avoid getting exploited. They're taking security serious, but as long as a project continues to avoid getting exploited, even the DAO in the future, I mean, we can't have any more DAO exploits. As long as the project can continue not to get exploited, I believe that's going to be really, really good for the project. But there's so much money, I think, going to come into this project and the complex smart contracts in place that I think that they're going to be a huge target for potential exploiters and flash loans. The goal is that no one is going to actually succeed at it. So we'll have to wait and see. The other one is, so if it depegs again significantly, if the project depegs goes down to 50 cents, 30 cents, can it repeg? I think it can, but we're going to have to see. And the reason this matters is because of the debt that it takes to repeg. And that's really part of the ugly. I'm sharing with you the bad, some of the risks that we have to be aware of right now. It's a new protocol. It's partially unproven. We don't know if it can maintain close to peg long-term consistently. And if it depegs, we don't know if it's going to continue to be able to repeg. It has repegged in the past. That's good. We just don't know if it's going to repeg in the future. Of course, it's got to avoid getting exploited. But when it repegs, the protocol takes on a tremendous amount of debt. There's over $700 million in debt on the protocol right now, which it appears to be paying back just fine. And currently the creditors are not worried about it. Like, they just keep giving money to the protocol. Heck, I'm trying to give money to the protocol. Here's why. Someone recently asked me in my Telegram group, why are you willing to invest at $700 million in the pod line? And I said, because I think there is about a 10% chance this project could succeed, worst case scenario, long term, and pay off that pod line. And the pod line is paying 50x. So I'll take a 1 in 10 risk to be able to get 50x on my money, earn 50 times on my money. So right now the project is not having problems with creditors, but we've got to see, they've been optimizing the debt payback so it doesn't take on as much debt and it pays down the debt a little bit more aggressively. And when I say optimizing it, I don't mean they're just randomly changing numbers. They're optimizing the actual math that the algorithm uses to make certain that it is operating in a way that is far more efficient. And they're really focused on organic growth, and that's probably a positive as well. But they're really focused on organic growth, and that's all well and good. But getting back to the negative, is the project going to be able to attract the big players? I think it will be able to attract the big players, but we're going to have to wait and see what happens. Hey, ladies and gentlemen, let me know down in the comments. Do you think that we need a decentralized algorithmic stablecoin in crypto? I mean, I personally do, but I'd love to hear what your thoughts are. Also, are you familiar with the Beanstalk protocol? And if you are, do you have any questions? Or what's your favorite part of the protocol? What do you like about the protocol? Let me know down in the comments. And stay tuned, ladies and gentlemen. In my next video, I'm actually going to walk through the website itself and give you a full tutorial on how to use the website. And I can say this, one of the negatives is the website is not very intuitive initially, but I'm going to make it simple for you to understand coming up in my next video, so don't miss it. Make sure that you smash the subscribe button, click the bell notification icon, and click all. And if the video is already live, I'll try to make certain to link it on the end screen, or you can look at it on the playlist. It should be the next video coming up. Hey, thank you so much for watching. Ladies and gentlemen, decentralized cryptocurrency equals freedom. This is Crypto Wealth. I'm out.